Lane Kowaoka says simple passive cash flow is the way to go. Hear all about passive real estate and financial investing, why saving in your 401k long term just doesn't work and there's a better way. And if you're a real estate investor and thought using the 1031 exchange to shelter taxes is the way to go, I got news for you. There may be some other real truths to consider. This and a lot more coming up next. Stay tuned.
Are you a trader or business owner, or anyone just wanting to learn how to be healthier, better, and more business savvy? You've come to the right place. Welcome to A Trader's Life with your host, Rick Mazer.
Hey everyone. This episode is brought to you by Futures Trading Coach. If you're a day trader or thinking about trading the financial markets short term for a few hours a day, definitely go to www.futurestradingcoach.com and check out what they have to offer. That's Futures Trading Coach. So for today's interview, I had the opportunity to sit down with Lane Kowaoka. Lane's been investing for over a decade and now controls over thousands of units, 4,000 or 5,000 units. As the owner of crowdfundaloha.com, simplepassivecashflow.com, and reialoha.com, Lane's responsible for finding investment opportunities, analysis, and marketing. Mr. Kawaoka, as he's going to explain to you in the interview, got his engineering degree. He also got an MS in civil engineering and construction management from the University of Washington. In addition to an analytical engineering background, Lane has real-world experience in working as a project manager for over $250 million of capital construction projects in both the public and private sector. Working as a high-paid professional in corporate America, but frustrated by the traditional wealth-building dogma, Lane was compelled to inspire and mentor other working professionals via his Top 50 Investing podcast. I hope you enjoy the interview. Stick around after the interview where I'm going to give you my breakdown of some of the things we discussed and just my general thoughts on the different topics and things like that. And I think it should be fun. Here's Lane, everybody. Hey, Lane, welcome to the show.
Hey, thanks for having me, Rick. Aloha, everybody.
From Hawaii, Honolulu, right?
That's correct.
Awesome. Yeah, so I wanted to have you on the show. I think you have some interesting perspectives on things investing related, real estate related, and I think the audience might enjoy it. So why don't you just start, kind of give us a little background of your story and how you started it and everything like that, and we can go from there.
Yeah, so currently I own 4,500 rental units, mostly apartments in the workforce housing sector. Didn't always start off like that. I grew up, they taught me to be frugal, go to school, study hard. For some reason, I became an engineer and started working for the man. And I saved my money up to buy a house to live in, because that's what everybody says you're supposed to do. And because I was working on the road a lot for work, as most young professionals are, I just decided to rent it out, because it seemed like a waste of money at the time. And that was where I realized of this thing called passive cash flow, where my rents more than exceeded all my expenses and mortgage for that rental property. And that was back in 2009. That was kind of the start of this mad craze to buy more and more rentals and finally quit the day job as an engineer.
So you used your engineering degree knowledge to kind of reverse engineer the typical wealth building strategies that like the more affluent people and the super rich have traditionally followed to allow the typical passive investor to benefit and participate?
Yeah. Obviously rental property gets your net worth up there. But then I later on realized the secrets of the wealthy, which we can talk about later. But, on that first rental, I was making several $100s every month of cash flow. And I was like, shoot, if I just did this a few more times, I'll be able to escape the rat race and, leave my day job. So that was what I did from 2009 to 2015 as I acquired, one rental by one rental, eventually having 11 single family homes by 2015.
And when did you decide that? Did you decide at some point that 11 was too much and you wanted to switch to something else? I mean, why not go to 20 or 25?
Yeah, so I guess like 10, 11 is a good sample size, right, for people to kind of understand it's a magnitude of 10. But with those, each rental property brought in a few $100 of cash flow. So times 10, that was like, a few $1,000s of passive cash flow a month, which is awesome, right? I mean, who wouldn't want that? But I think that was, at that point was when I started to join higher level masterminds, getting around other accredited doctors, lawyers, engineers that were older than myself at the time. And I started to realize, or started to learn from them, that rental properties, great way to get started, but it's very different than what higher net worth accredited investors do after a certain point. They go into these private placements and syndications or country club deals where they're passive LP partners, limited partners, so they have little to no liability, they don't get any of the debt in their name. And the greatest thing is that they don't do anything, right? They just invest their money in their passive LP partners. The problem with this is finding the right people to work with. And this is why they're called country club deals, right? So I started to transition my portfolio from these rental properties, which became a sort of a pain. I mean, with 10, 11 rentals, I had an eviction every other or one or two a year. And I had some kind of big issue that happened, like a tree fall on the house, some kind of big washout or rainstorm happening, or plumbing repair happened every maybe quarter, which was no problem because I had professional property management on every single one of these properties because each one of them met the 1% rent to value ratio and they cash flowed. But my role was the asset manager. I had to manage the manager, right? Ensure that all these repairs get done properly and quickly so I can get my money, right? But, for $3,000 a month, you're going to need, I don't know what American family can survive off $3,000 a month. They're going to need like 10 grand or more. So you're going to need to multiply that to 30 houses and multiply that exception rate, right? And you can quickly see how this becomes unscalable. Now you're talking about an eviction every other month, some kind of big issue that happens every couple of weeks. For good reason. It's just not what high net worth people do, right?
So do you recommend that people start there anyway?
Yes.
It would be kind of hard to start higher than that at a higher level, right?
Yeah. So like my website kind of caters towards working professionals, people with some money, right? Like if you're broke and you don't have a good paying job, probably don't come to simplepassivecashflow.com, right? Like it's for people who are pretty good with their money, right? Like as I was. I mean, I didn't start off with much. Luckily, I didn't have too much student loans graduating college, but I was really good and frugal with my money. I was able to save 50 grand a year to put to investments. And it just took a lot of time from 2009 when I bought my first property, and then took me all the way 6-7 years to get up to double figures. What my general recommendation for people, the prescription is, if your net worth is under $250,000, $500,000, you need to get some rental properties. You need to get your net worth up. But once you go above that threshold, certainly to accredited investor status, so you're $1 million net worth or above, or making over $250,000 a year, I would say rental properties just aren't scalable for you, and it's kind of a waste of time. And that's where these private placements and syndications come into play.
So you can help. So let's say somebody had a rental property or two, but they fit that criteria, then that's where a site like yours, Simple Passive Cash Flow, could help them. Yeah.
I mean, I like to kind of help out everybody, right? As long as they make a professional salary, right? So the guys under $250,000, we have a lot of free content for them, how to buy their first remote rental property. Because for a lot of guys, at least, we have a lot of folks on the East Coast and the West Coast make good salaries, but they're horrible places to invest, right? Like I would never invest in Los Angeles, Miami, San Francisco, Seattle, New York, Boston.
The primary markets.
Primary markets, right? We invest in secondary markets such as Birmingham, Atlanta, Indianapolis, Kansas City, Jacksonville, right? These are boring places where the key is you can buy good houses that meet the 1% rent to value ratio.
Okay. Yeah, because you can, like you said, the primary markets are pretty much too pricey out there and hard to kind of manage, right?
Yeah, I mean, they're expensive, but I think the big thing is like the rent that you get per dollar spent it doesn't really make sense, right? We're buying properties where if we're buying $100,000 house, or it's renting for $1,000 a month. Whereas in California, I mean, you'd be lucky to find a place in the ghetto for $400,000 that rents for $2,000 a month. That's 0.5% rent to value ratio. That's no white out land, ain't gonna work.
Correct. Exactly. So if somebody is a busy professional or a business owner, maybe they're already investing in small rentals, but just want to get out of dealing with all the day-to-day stuff and wants to learn more about syndication, which, as we discussed, is pooling of capital to invest in an opportunity. What should they do?
Yeah, I would say at that point, go and check out simplepassivecashflow.com/syndication. Read that kind of intro guide there. I think what's hard about syndications for passive investors is any yo-yo can do a syndication these days, right? I mean, anybody can make a podcast and create some social proof facade. Who do you know who to trust, right? I mean, I lost $50,000 in my first deal investing with the wrong person because I didn't have a network to be able to vet out the sponsor and the operator. So it's, you need to network of pure passive people around you. And that's something that not a lot of people can do, right? They can't build relationships. We're all kind of out of touch this last year of social activities. And, it's just, we're all separated in this world. And most likely, I mean, I never had it, but people in my network when I was, 5-10 years ago, they're all just W-2 people, just brainwashed by all the 401k, buy a house to live in, that type of stuff. They're not investing and thinking this way of investing off of Wall Street.
I think just with investing in general, especially in certain areas, investors can get a little gun shy because they don't know where to go. I think if you asked most people, they would say, sure, I'm making X amount over here and dealing with a bunch of headaches and everything like that. And if I have an opportunity to make even more with less time, it all sounds great until, as you said before, they have to go find the right network and have that trust and everything.
Right. Exactly. But I mean, if somebody's never owned rental real estate before, it makes it really tough to evaluate a deal from a pitch deck perspective, right? So that's why we try and educate people from the start, like they're picking up their first rental property, because the fundamentals carry on all the way through, whether you're buying your own rental property in Birmingham, or you're investing as a passive investor in a larger deal.
And when you say syndications, for people who don't understand what that means, what do you mean by syndications?
Yeah, so syndication is kind of like I think it's like a verb. It's a way of pooling together investors' capital, sort of like a mini co-op or mini crowdfunding, where now a bunch of investors can team up as passive investors and go after a larger asset, and there's a general partner that operates said investment on behalf of the passive investors. So, I think what we try and do is we try and go after deals that are in the 100 to 300 unit spectrum, where we stay below the institutional players. The institutional players are just trying to make a very low, lame yield for their retirement funds and pensions. They're kind of lazy money, and they're typically paying in the $30 to $50 million range and above. Where your mom and pop investor, your unsophisticated landlords, there's a lot of them out there. They kind of stay below the $1 to $2 million range. So we stay around the $2 to $30 million range, and where there's low competition and there's good deals that we can have that not many people can compete with us on.
How many people are typically in those deals?
Typically, on a smaller deal, like a $5 to $10 million deal, maybe about 20 to 30, but we've had upwards of 120, 150 investors on some of the larger projects. And this is like the idea, right? Like passive investors, you do give up control. Most of our investors are self-aware enough to know that they have their full-time day jobs, that they may be a doctor. They have no ability to concentrate and run the deal, and they don't have the contacts and the deal flow, which is why they think that they're better off within the bigger unit.
And are they kind of locked into these deals? I mean, is there a time frame that typically you're locked into that?
Yeah, they're locked in, but the idea is they're diversified over dozens of deals, right? So they, quite frankly, don't really care. And I don't know where else they can make a higher return. So why would they not want to be locked in?
Right. Exactly. No, that makes sense. You mentioned, I read on your website about house hacking. What is house hacking?
Yeah, so house hacking is one of these things that the kids are doing where they buy like a duplex, triplex, or quads, live on one side. I mean, it's cool, it works, right? But, not for accredited investors or higher net worth people or people over the age of 30, in my opinion, right? You don't want to be living next to your landlord. Like, I sure as heck don't want to do it,
Or renting out
but
renting out to a lot of college students is popular here. They get a house and they rent the rooms out as individual leases, and it's like a shared family room and all that. And I can just imagine
right.
that's a mess waiting to happen.
I mean, it's cool if your net worth is under $250,000 and like you make under 80 grand a year, then do stuff like that. I did a lot of crazy stuff when I was younger, in my 20s and even in my early 30s, right? I mean, if people want to go look at all like the crazy stuff I did to save money, go to my website, simplepassivecashflow.com/cheapo, and all the shameless things I would do to save money, right? But what I do is use that money to do is go buy and hold rentals, right? And after a while, it steamrolls, and you get to a point where you start to realize everybody's trading time for money, right? At their day jobs, or even with this like cheapo stuff, right? After a certain inflection point, you start to get your head above water, and you start to realize time is more valuable than money, and that's where the syndications come into play, because it's a sort of infinitely scalable.
And when you're talking about having the money locked up, I mean, what kind of time frame are we talking? Like 5 years, 10 years, 20 years? Or?
I mean, you can syndicate anything, right? So there's a whole world of things you can possibly invest in, right? So from you can syndicate a rental property. You can syndicate 10 to 200, 300 units, right? In different business plan. You can syndicate a brewery. You can syndicate a tech startup, right? But in the world of real estate, right, like typically what we like to do is we like to go in with a business plan. We like to buy a stabilized asset, 90% occupied or more, that's cash flowing day one, and with the rents being a little bit undervalued. So we would like to rehab the units. So very, very much like putting lipstick on a pig. So maybe $4,000 to $6,000 of rehab, new flooring, new appliances, new paint job, maybe some playground equipment on the outside, new clubhouse. But we want to bump the rents up $100, $200 a month on every unit. And just as units come up for natural turnover, we don't want to kick out tenants because then our cash flow would suffer. So in this fashion, I mean, typically tenants that live in apartments, there is some turnover rate, right? So in the first couple of years, you'll go through most of the units to rehab. So probably could take maybe 2 to 3 years, and we also like to tack on a couple of years on there just to be safe. So anywhere from 3 to 7 years.
Yeah. So so it's a deal by deal type of basis, and then they can get involved if they want to, or they don't really have any control over that, or do they?
They don't have control as the passive investors. They're in on the boat, but they have a very small part of their net worth.
Yeah, it's all fine, especially if they're taking a point. Yeah, exactly. So I was looking also, I noticed you have this QRP book. And there's a lot of people I know. I want to shift gears a little bit more to the, 401k, because I know you talk a lot about 401ks and the money should be in real estate versus sitting in a 401k forever. Can you talk about that a little bit more?
Well, I think the big thing that kind of burns me up a lot is like when I was first investing in real estate, I was making maybe 30% of my money or greater when you include the cash flow, the mortgage pay down that your tenant is doing for you, as opposed to in your house when you're paying down your own mortgage. The tax benefits, we can talk more about that, and the appreciation that you're getting. So when you add all that up, it's about 30% plus. And if you don't believe me, you can go to my website, simplepassivecashflow.com/returns, and look at my little whiteboard video on that, doing the math. If you guys don't believe me. But, very early on, I was like, what the heck? Why am I investing in all this stock fund, mutual fund garbage, 8 to 10%, when I can just do this on my own at 30% plus, right? That's ultimately why I chose to get off of that Wall Street type of stuff. And then I start to realize this whole system is engineered so that people stay working for the rest of their lives, right? to me, like the analogy I like to use is like, remember when we're all in high school and you're kind of captive to all that garbage cafeteria food, right? It was expensive, it sucked. As soon as you got your off-campus pass, you're out of there, right? You got your Taco Bell, you got your KFC, McDonald's, and yeah, that's garbage food. But the whole point is, when you're stuck in that 401k, you're stuck with the cafeteria of garbage investments, and it's retail investments. What I really should be using the right term, right? Retail is like buying the same pair of Nikes at Neiman Marcus or Nordstrom. I don't do that. I don't want to pay an extra 20-30% for the same dang thing, right? I'm going to buy those pair of Nikes elsewhere. Same thing with investments, right? Everybody is kind of moved into this like a cattle herd, into the slaughterhouse of these mainstream retail products. And if you look at it and you start to analyze it, there's huge fees that are being taken out of this stuff, even if it says no fees.
Right. Front load, back load, all that kind of stuff. Exactly.
Right. I mean, if you say you got your low ETF thing, I'm like, whatever, man. I stopped believing in the Easter Bunny, Santa Claus, and all that stuff a long time ago.
Well, because I think we're all taught, well, at least I was years ago, you save your money, you put your money into retirement, let the company contribute their part, and then hopefully you have a big enough nest egg to where you can live off 4% or whatever you're going to withdraw. But that hasn't seemed to work for a lot of people, over time. So
I mean,
they need to amplify that. All right.
If everybody just went out and bought a few rental properties, they'd be on the path to financial freedom very quickly. I mean, most people that kind of come to simple passive cash flow are like, they're free in 5 to 10 years.
Right. And that's why I wanted to have you on, because I think there's two different categories, like we said, of people. There's the people that are starting out or maybe have a little bit less and they want to start with, but there's also people that, don't have the time and just take it. I value my time more. Yeah. And it's great because you can start with one and you can kind of graduate into the other thing as you go along. And there's a lot of resources on there to do that as well, which is wonderful. Wonderful.
Right. And for like the new people, you kind of touched upon it, the 4% rule, right? Or whatever they say, the 3% rule these days. Like the traditional wealth building dogma that they tell us is like, be a good little boy, right? Go to school, Lane, study hard at math, be an engineer for 40 or freaking years, right? Like, and be a good boy and stay in that system, right? And put your money in blindly in this program, and it's called the accumulation theory, right? You grow your nest egg, you build a pile of money, you live off of it for 4% for the rest of your life. But when you get to that point in retirement, you're going to need to put food on the table and eat your pile of cash. You're going to need cash flow. So I'm like, well, why don't you begin with the end in mind now and create those streams of cash flow today? And that's what these little rental properties are. That's what these syndications and private placements are, right? And this is like kind of reverse engineering the whole thing and putting the end in mind. Create mini streams of cash flow today, multiple streams of income. I don't know what could be more like diversified, more safer than that, than just all putting in one pile to the very end. But that's what all the dogma has us doing, right? When really we want to be creating multiple streams of income from different investments, so we're diversified from any one particular event or bad event happening. And what's cool for high paid working professionals is like, we don't need to eat those streams of cash flow today, right? Just like when I bought those first rental properties, I didn't need to eat the cash flow. I had my good paying day job. But I can use those streams of income to buy more properties quicker and quicker and quicker and quicker, and it kind of snowballs.
Well, they're taught that put the money in tax deferred, and then it'll grow, and you won't have to pay the taxes on it. Whereas, with real estate, theoretically, I know you have the calculator on your website, which I think is great that people should go to, because they can see there are other options out there instead of just the traditional way.
Let's break that down, right? Because you are correct, right? And that's why people ultimately put their money in these retirement programs, is when it's in this container, it grows tax-free, right? But there's 4 big reasons why I don't do any retirement things, and high net worth people don't do it either, right? So it should make your ears perk up. right? First reason is all this advice is predicated that when you get older, you're going to shrivel up and die and make less money and be in a lower tax bracket. But I don't know about you, Rick. I mean, you and I are probably going to make more money in the future, right? And be in a higher tax bracket. One would be optimistic, right? We're optimistic kind of guys, right? Right. The future is bright.
Of course.
For everybody listening to here, right? So doesn't it make sense to pay your taxes today at the lower tax bracket today, right? That's point one. Point two, I mean, look where this country is going. We have all these government entitlement programs, all this like printed money from the series of stimulus, and there's more to come. Taxes are going to be going up. Of course, inflation too, right? And real estate is a great hedge of inflation. Ultimately, as the person who loads up on good debt, I'm the beneficiary of that. But that's another point. But yeah, taxes are going to be going up. Tax brackets are going to go up. I want to pay my taxes today to get it out now before the tax brackets go up. Point number three is I'm not waiting until I'm down near 65, 70-year-old to get the money. I retired already. I've done this in less than 10 years personally, and I've seen many people do it in a lot less than that. Fourth is kind of debucks the whole tax-free thing. Yeah, when you're investing in a retirement fund, it grows tax-free, but so is with real estate, right? When you invest in real estate shows a paper loss because it depreciates on paper. But here's the cool thing when you invest in private placements and syndications, that if you guys are rental property owners now, this is the game changer right here. So on these larger assets, I can do what's called a cost segregation, depreciate this asset a heck of a lot faster than I did a rental property. For those of you guys with rental properties, you guys know you can deduct 1/27th of the value of the improvement over 27 years. Sounds great. It is great, but it's kind of lame because it takes 27 damn years to do, right? But when you do a cost segregation, you can deduct 1/3 of that building all in the first year, right? So now I'm creating this huge passive loss that I can choose how to use it. And in the past, I personally elected not to pay taxes because I can use my passive losses to drive down my income. So we do this with a lot of the doctor clients, right? There's a lot of different strategies that we'll use to lower their AGI out of that $330,000 and greater, so where they're getting killed, right? So these passive losses from the real estate allows you to pull levers. It gives you options. Yes, you can invest in your retirement fund to real estate. There are different QRPs, like you mentioned, self-directed Roth, self-directed IRAs. I don't personally like them because when it's in the retirement bucket, you don't get any of these passive losses to offset what you're doing today on your taxes.
And then you also have the 1031 exchange that people use for deferring as well. Right?
I don't like that either. I mean, to me, I don't know why anybody does a 1031 exchange. To me, they're obsolete because like when I sold my 7 rentals a handful of years ago, I had a $200,000 capital gain. But I went into a bunch of deals and I had several $100,000 of passive losses, which I used to offset that gain. I didn't need to do a 1031. And 1031s just screw you over the next time you're looking to sell that property because you have this big depreciation recapture. What you want to do is you want to break it up in smaller chunks so you can better equip yourself to defer that. And everybody knows 1031 buyers are suckers. They're distressed buyers. They have to buy. So they're always going to be purchasing for a higher price. I lick my chops when we find a 1031 buyer because I know they're desperate. And I know I can hit them and hit them hard and have them overpay.
Well, that's why I like what you're doing because there's a lot of guys on there, especially if you go to YouTube and all that nowadays, they're touting that whole, they make it sound glamorous and they make it sound like they're big time and they're taking advantage of the tax system and they're able to defer. But you always got to get a bigger deal. And you always have to upgrade, or you always have to, like you said, if they come to you and you know that they need it, then you're gonna be able to get a better deal for yourself, probably.
And I never wanted like this is what the mom and pop investors do, the unsophisticated investors. They go from single family home, the duplex, the quadplex, 8plex, 16plex, and they just keep going up and up and up. And they're always getting screwed along the way because they're 1031 buyers. But the biggest thing is they're kind of disobeying one of my cardinal rules is like to never have more than 5-10% of your net worth into any one deal, right? That's diversification, right? And these guys are just violating that. Like, obviously, like they just keep going up and up, a big chunk of their net worth into that one asset.
And you help them do that diversification through spreading it around if they've got enough resources to do that.
Yeah, we help investors by letting them chunk into different diversified investments. But that mom and pop investor, we screw over. We buy their property when they're distressed. But we take that deal and share it amongst other people.
And that's why I found that what you were doing was so interesting as well, because again, a lot of people are getting pushed down that path. And sure, I guess it's better, like you said, than having them. It's probably better for them than having their money in a retirement or sitting there doing nothing. But there are better ways and different ways to do things, and that's, this is one way to go about it. And you have a podcast as well, Simple Passive Cashflow Podcast. And what type of stuff do you talk about on there?
Yeah, so our folks, our tribe, are people who are successful entrepreneurs, high net worth, make a good salary at their job, and they're looking for something simple and easy. And when you have a lot of money, it is kind of simple and easy, right? All this house hacking, burst strategy, tax liens, flipping houses, that's all for like guys who don't have money and they have to they have to find a day job within the real estate world, right? I was an engineer. I had a decent amount of money coming from that. And for a lot of people, like, we help out people kind of moving over from other avenues. Maybe they've gotten out of a startup, right, that they exited. Maybe you just want to take some crypto returns off the table, right? The hard thing about like everything but real estate is you get hammered with taxes, right? And real estate is a hard asset at the end of the day. So it's the perfect end game strategy, right? Don't come to my website if you don't have money, because this is simple passive cash flow, right? If you want to find diversification in real estate and kind of lock up your money in something, probably the most stable thing out there, because they're not making more of it in a tax efficient manner, that's real estate. And kind of going back to what you're talking about, the taxes, I mean, let's try and stay in my lane with the real estate realm, but I do recognize, I don't stocks, but I like a little crypto personally, but that's what the retirement accounts are for, the QRPs and the self-directed IRAs. Because the crypto stuff, the trading stuff, you don't get the tax benefits that you do real estate. You can't depreciate your stock, right? There's no paper loss on that stuff. So that's the ideal tool for that type of position.
You bought a bunch of Bitcoin at $500?
No, I wasn't. I think at some point, to the things that we talk about in our realms, I also run a family office, Ohana Mastermind. So high net worth investors, where most of us come from the real estate side. We're more, I don't want to say prudent, but more traditional conservative investors. We want hard assets in our portfolio. But as our net worth grows, $1, $2, $5 million, $10 million and above, I think it's appropriate to expand your crypto holding, maybe anywhere from 1 to 10%. The bigger percentage going to more people who have a larger net worth, right? That's just how I am. I mean, as a more conservative investor, I'd rather an investor start off with cash flowing investments first. And then as you net worth grows and you don't need that cash flow to put food on the table, yeah, that's when you get a little more ballsy and you go after asymmetric risk.
Exactly. Makes total sense for sure. Well, Lane, it's been a great time. Definitely some good information for people to think about, take action on if they're interested. And I really want to thank you for being on the show. I will have all of Lane's information and links on the website on our show page. Check out Lane's podcast at simplepassivecashflow.com or whatever podcast platform you like to listen to shows on. And don't miss it if you're someone that has investable assets looking for passive income stream opportunities. Right.
Not super active, broke guys trying to do a bunch of rehabs and flips. No, just you got some money, you want to learn how to do it passively, and you trade time for money some other way. Maybe you're a good stock trader, you're a doctor, lawyer, engineer, we're the tribe for you.
Yes, that is exactly what they need. All right, Lane, have a great day.
Yeah, thanks for having me, Rick. Aloha, everybody. Bye.
If you enjoyed the interview, stick around and listen to this quick word from our sponsor, and I'll be right back with a recap. Many people like the idea of day trading for main or supplemental income. And if you have a business and have a flexible schedule, or can just carve out a few hours in your day and are interested in day trading futures, stock, or even Forex, Futures Trading Coach offers a few different options that can help you. You can look over the shoulder and see into the mind of the futures trading methodology via the Trading Alert call room. In the call room, you get live signals telling you exactly where to get in, the direction, and they even help you manage your trade if you need it. You also get market analysis and all of your trading questions answered. If you want to learn to be a consistent trader, Futures Trading Coach also offers a full mentorship academy where traders can learn about the markets, how they work, how to get into trades, and they have 8 proven trading entry signals. But entry signals aren't everything. You also learn everything you need to know about trade management, position sizing, trading psychology, profit taking, targets, market reversals, and much more. The methodology the Futures Trading Coach employs is based off of price action, support and resistance, but also the understanding of who is doing what in the markets, where they're doing it, and how you can take actionable trades with a very high level of consistency. Check out www.futurestradingcoach.com. It's where I learned most of what I know about day trading. They've been around for over 20 years, and the owner, Sam, is a really great person and a great mentor to have on your side. I highly recommend them. You will not be disappointed. So that's it for today's show. Let me know what you thought of it. I'd really appreciate it, and it will help make these shows better for you. Feedback is a very valuable tool to get better at anything. You can hit me up at Twitter at RickMaz1106, that's RickMaz1106, or on Instagram at RickMazer1, RickMazur1. Use the contact form on the website, rickmazer.life, and we'll also have everything in the comments section for each show page. I personally look at all the feedback on the site as often as I can. Finally, if you have anything to contribute or ask, or would like to appear on the show through an interview or one of our other segments, you can leave a voicemail at 1-800-590-0174 or by contacting us on any of our socials or use the contact form on the site. We'd love to hear from you. I consider us all a community, a group. Let's remember, in today's more challenging world, we are people first. We're humans who just want to be treated as such and live in a place where we can all prosper and live well. Bye for now. Until next time. See ya.